Welcome back to the deep dive. Today we're cracking open the latest numbers from a real giant in global IT. Their quarterly results just landed, and while headlines often just grab the revenue figures, the real story this time, it's about something much bigger. A huge, actual, concrete plan to become the world's biggest AI-led tech services firm. Okay, so let's get into that. Our deep dive today is all about Tata Consultancy Services, TCS. Specifically, their Q2 results for fiscal 26, so that's the quarter ending September 30th, 2025. We've got the financials, obviously, but also some really interesting client wins, huge investment plans, and kind of where global IT demand seems to be heading right now. The goal for you is to figure out how TCS is actually doing what they say they're doing, transforming into this, what do they call it? The perpetually adaptive enterprise.
Yeah, that phrase really jumps out, doesn't it? Perpetually adaptive enterprise. For anyone tracking the industry, it's basically about building client systems that are, tough, resilient, they update themselves, react to big shifts like AI or supply chain chaos, right? Without needing a total rebuild every few years. It's agility. And what's really fascinating here in these numbers is how they've balanced things. You've got this solid Q2 performance and then these massive bets on the future.
Right, huge bets. They landed strong revenue growth, sure, but maybe more importantly, a record-breaking deal pipeline. And at the same time, announcing these, well, foundational investments. We'll hit the core numbers first, but then we really need to pivot to the most interesting part, this huge commitment to AI infrastructure and talent. All right, let's start with the hard numbers. How did they actually do? Against all the, global economic headwinds we keep hearing about, total revenue landed at 65,799 crore, and sequentially, that's 3.7% growth quarter over quarter in reported terms.
Yeah.
But that includes currency effects, right?
Exactly. And that's where, it gets a bit technical, but it's super important context. Currency volatility is high, so we always look at constant currency, or CC, growth. That strips out the currency swings and shows you the real underlying demand. In CC, growth was, well, more moderate, 0.8% quarter on quarter, and international revenue growth was just slightly behind that, at 0.6% in CC.
Okay, so steady growth, not exactly setting the world on fire, but holding firm, reflects that caution out there.
Precisely. Stability over sheer speed right now.
But here's where it gets really interesting, especially if you track efficiency. The margins. Operating margin expanded by 70 basis points sequentially. 70. Up to 25.2%. That's a big jump.
It is a huge jump, and it's absolutely critical because, look, while they grew sequentially, the actual net profit was 12,904 crore, which sounds big, but is actually down 8.4% compared to last year.
Ah, okay. So that margin improvement is key to maintaining profitability then.
Absolutely. The CFO pointed out they achieved this expansion, the 25.2%, across all their business verticals. It shows they're running a really tight ship. Disciplined cost management, probably some smart automation paying off. Even when clients are being careful with spending, TCS is finding ways to be more efficient.
Right, and that efficiency, that discipline, it lets them really capitalize when they do win big deals. Which brings us to the future outlook. The most impressive signal there has got to be the deal pipeline itself. Total contract value, the TCV, signed in Q2, a massive US $10 million.
$10 billion. That confirms the deal momentum is incredibly strong. But, it's not just the size of the TCV number.
Yeah.
It's the quality of those deals. When you see margins going up and TCV hitting records like this, it strongly suggests these aren't just low-margin, keep-the-lights-on deals. They're likely more complex, higher-value transformation projects, digital AI stuff.
Exactly, the kind of work that actually fuels future growth.
Yeah.
And just to round out the financial health check, cash flow was, well, phenomenal. Cash flow from operations hit 110.1% of net income.
Wow, that's extremely strong cash conversion.
Yeah, it means those profits are turning straight into cash they can actually use, which gives them loads of flexibility for those big AI bets we're going to talk about.
Makes sense. Oh, and they declared a dividend too, right?
Yep, €11 per share. So rewarding shareholders while funding the future.
Okay, so the financials look pretty solid overall, tight operations, good cash flow, strong bookings. But where did that $10 billion in deals actually come from? Let's break down the demand.
Yeah, you got to look beneath the surface, right? See who's spending and who's pulling back. Industry-wise, life sciences and healthcare led the pack. Really strong growth there, plus 3.4% quarter on quarter in constant currency.
Interesting. That suggests complex, regulated industries are still pushing ahead with big tech investments.
Definitely. Manufacturing also did okay, up 1.6%. And BFSI, that's banking, financial services, and insurance, was up 1.1%. So positive contributions there, too.
But there was a weak spot, wasn't there?
Oh, yeah. a pretty significant one. Communications, media, and information services. That sector actually contracted, down 5.1% quarter on quarter in constant currency.
Ouch. Minus 5.1%. That's a sharp drop. Clearly signals some ongoing sector-specific pain there. Probably pressure on telco spending, media budgets, that kind of thing.
Seems likely. So that unevenness definitely raises the question, how did this play out geographically? Where are the strong and weak markets?
Well, it's a classic mixed bag, really. Interestingly, India itself was the growth leader for TCS this quarter, up 4.0% QOQ in constant currency.
It's domestically strong then.
Yeah, and Asia Pacific wasn't far behind, up 3.0%. So good regional performance.
Okay, but what about the big engines, North America and Europe? Historically, they're key.
North America, always the bellwether, grew 0.8% QOQ.
Resilient, but like you said earlier, moderate growth.
Exactly. Not spectacular, but holding up. Europe was even more split. Continental Europe actually did all right, up 1.4%. Decent momentum. But the UK.
Yeah.
The UK segment contracted by 1.4% QOQ.
Down 1.4% in the UK. Okay. So it really highlights that uneven global demand picture, doesn't it? Pockets of strength, but also clear areas of caution or weakness sensitive to local economies.
Definitely. The demand environment internationally is choppy.
Okay, so we've got this picture now. Solid foundation, good margins, great cash flow, huge order book. But growth is patchy. Some key markets like the UK and key sectors like communications are actually shrinking right now, which brings up a really critical question. Why go all in on this massive AI transformation now, announcing gigantic data centers when parts of your core market are pulling back? It feels like a huge gamble.
Or maybe aggressive leadership, right?
Yeah.
Seizing the moment is a strategic sprint, exactly like you said. And yeah, it might feel counterintuitive given the mixed demand, but they're clearly translating that vision, becoming the world's biggest AI-led services company, into very real, very immediate actions. This isn't just talk anymore.
And the most obvious, most physical example is that infrastructure plan. They're setting up a whole new business unit just to build AI infrastructure, starting with a 1 gigawatt AI data center in India. 1 gigawatt.
Yeah, 1 GW.
Yeah.
Let's just pause on that. That's not a minor detail. To give you some perspective, that's getting close to the power draw of a small city, just for AI compute.
Wow.
The strategic thinking here, it has to go beyond just needing more servers. They must see that future AI, the kind enterprises will rely on, needs absolutely massive, secure, reliable power. By building their own, they kind of de-risk their power supply. You bypass some reliance on the big cloud hyperscalers like AWS or Google Cloud.
And maybe offer clients with super sensitive data a more proprietary controlled environment.
Exactly. It looks like vertical integration of the AI stack right down to the physical layers. Profound statement.
And it's not just about building these huge facilities. They're also buying expertise, right? The ListenGauge acquisition.
Right. ListenGauge Midco, a US-based Salesforce partner. They bought 100% of it.
What do they specialize in?
It's a classic capability buy. ListenGauge focuses on digital marketing, cloud, data, something called Agentforce, and critically, AI advisory services within the Salesforce world. Their TCV in FY24 was around $24.3 million.
Okay, so small relative to TCS overall.
Tiny, yeah. But it's not about the revenue size. It's about grabbing specific high-demand skills quickly. This instantly beefs up their Salesforce practice and brings in ready-made AI consulting talent for that ecosystem. Smart move.
Okay, so connects back to that massive $10 billion TCV figure we talked about. Presumably, the types of deals making up that number reflect this AI-led strategy.
Absolutely. You can see it clearly in the examples they highlighted. There was a big one, multi-year, multi-hundred million dollars with a major global healthcare company. And the focus explicitly mentioned AI, cloud, cybersecurity, digital solutions, core transformation stuff.
Makes sense for healthcare. What else?
Retail and logistics saw action too. They expanded a deal with Aldi South for IT modernization. And they landed a new multi-year partnership with the Warehouse Group down in New Zealand. Again, focus on digital transformation, supply chain optimization.
So optimizing complex systems.
Right. And another one in Scandinavia with Tryg, a big non-life insurer. That was about simplifying and standardizing operations. These aren't simple lift and shift projects. They scream complex integration, likely heavy on AI and proprietary TCS platforms.
And underpinning all this is R&D, right? It's not just buying and building.
Definitely not. You have to look at the innovation pipeline, too. They filed over 9,200 patents cumulatively and applied for 239 new ones just in Q2.
Wow.
Plus, they announced key research partnerships, a joint lab with Qualcomm in Bengaluru, collaboration with MIT Sloan Management Review specifically on AI research. So yeah, they're betting on fundamental R&D to create the next wave of services, not just deploy current tech.
Okay, this brings us back to something interesting we touched on earlier, that UK market contraction, minus 1.4% this quarter. Yet at the same time, TCS announces they're creating 5,000 new jobs in the UK over the next 3 years. That seems bold.
It is bold, almost countercyclical, isn't it? They're essentially doubling down on the UK for the long term, despite the short-term dip.
Why do that?
Well, could be several things. Maybe they see the dip as temporary. Maybe it's about securing scarce tech talent there before others do. It's certainly buying political goodwill and cementing their role in the UK economy. They even launched a new AI experience zone and design studio in London alongside this.
Positioning the UK as an AI hub for them, despite the numbers.
Seems like it. And don't forget, they mentioned TCS contributed, what, 3.3 billion down to the UK economy last fiscal year?
Right.
So this jobs announcement reinforces that major economic partner narrative.
Yeah.
It's strategic beyond just immediate revenue.
And this global footprint expansion isn't just the UK, is it? Mexico City, too.
Yep, a new AI-driven operations center there. And that leverages a big existing workforce. They already have over 11,000 people in Mexico.
So they're building out these AI capabilities globally, wherever they find the talent pools.
Exactly. It's about creating a distributed network of AI expertise and delivery centers.
And how does the management talk about all this? What's the official outlook?
The tone is very much focused on this tech shift. The CEO talked about their strategy being anchored in transforming four things: talent, infrastructure, ecosystem partnerships, and customer value, all aimed squarely at becoming that AI-led technology services company.
Right.
And this quarter really shows they have the financial muscle to do it thanks to those strong margins and cash flow we discussed.
Yeah.
And seemingly the corporate will to push hard on this strategy, even with that mixed global demand picture.
Almost like they see the current slowdown as a chance to invest and gain ground while competitors might be more hesitant.
Could very well be the thinking. Invest through the cycle. Hashtag tag outro.
Okay, so let's try and wrap this up. What does all this really mean for you listening in? Clearly, this TCS quarter wasn't just about, meeting the analysts' expectations for revenue or profit. It felt much more like a statement of intent, a strategic pivot for the next decade of IT. We saw those really solid fundamentals, especially that 70 BP's margin jump and the strong cash flow, impressive execution. But that was combined with this incredibly aggressive investment towards the biggest disruptor out there right now: artificial intelligence.
Yeah, I think that's spot on. The immediate takeaway for you, that huge $10 billion TCV number, it signals they are winning big, complex, valuable deals today. That's crucial for near-term confidence. But the longer-term takeaway, it's got to be that structural shift. TCS is very deliberately, very aggressively moving away from just being a traditional IT outsourcer towards being this AI-led technology services company. And they're putting serious money where their mouth is, betting big on owning the infrastructure like that massive 1 GW data center and grabbing talent globally.
Which leads perfectly into our final thought for you to chew on. We talked about that 1 gigawatt AI data center plan in India, a huge commitment to physical infrastructure. Now, think about the power needed for these facilities, not just building them, but running them, 247 at incredibly high density for AI workloads. How might the sheer energy requirements of large-scale proprietary AI start to reshape the competitive landscape? Who can actually afford to build and power these things? Will access to massive, reliable, maybe even green energy become a key differentiator for IT leaders in the next 5 years?
Oh, a really interesting angle. Does owning the power source become the next competitive moat?
Something to think about as you watch this AI infrastructure race heat up.